Hi. Let's learn about adjusting journal entry definition, purposes, types, and examples. An adjusting journal entry is made at the end of an accounting period to record any unrecognized income or expenses, as well as to correct any mistakes made previously in the accounting period. Adjusting entries are made to convert cash transactions into the accrual accounting method, based on the revenue recognition principle. For example, a construction company must do an adjusting journal entry at the end of each month to recognize revenue for work that will be invoiced at a later date. Accruals refer to revenues and expenses that have not been received or paid and have not yet been recorded through a standard accounting transaction. For instance, an accrued expense may be rent that is paid at the end of the month, even though the firm occupies the space at the beginning of the month. Deferrals refer to revenues and expenses that have been received or paid in advance, respectively, and have been recorded, but have not yet been earned or used. For example, unearned revenue accounts for money received for goods not yet delivered. Estimates are adjusting entries that record non-cash items, such as depreciation expense, allowance for doubtful accounts, or the inventory obsolescence reserve. Adjusting journal entries are important because they reconcile differences in the timing of payments and expenses and ensure that unresolved transactions are closed properly. For example, a company takes out a loan from the bank with interest payments due every 3 months. The company needs to accrue interest expenses for months before the payment is due to accurately report its operations and profitability. The purpose is to reconcile transactions that have not yet closed, such as payments or expenses that do not occur at the same time as delivery. The main types are accruals and deferrals, referring to payments or expenses on credit that are still owed, and to prepayments where the products have not yet been delivered, respectively. The primary distinction is in the timing of when expenses and revenues are recognized. With cash accounting, this occurs only when money is received, while accrual accounting allows for a lag between payment and product. Companies that use accrual accounting and find themselves in a position where one accounting period transitions to the next must make adjusting journal entries. Companies that use cash accounting do not need to make them. Here are 3 key takeaways. 1. Adjusting journal entries are used to record transactions that have occurred but have not yet been appropriately recorded in accordance with the accrual method of accounting. 2. The most common types of adjusting journal entries are accruals, deferrals, and estimates. 3. It is used for accrual accounting purposes when one accounting period transitions to the next. Hope this would help. Thanks for watching.